What's going on, everybody? This is Dr. Kenyon Hackworth from Healthy You, Wealthy You, where my focus is on improving health and building generational wealth. Listen, if you're new to the channel, please make sure you hit that like button and subscribe and leave a comment. I would greatly appreciate it. Now, Amazon recently announced a 20-for-1 stock split, and people are asking, should I buy Amazon stock before it splits? Now, the stock split, to explain it, I guess in its simplest terms, let's say you have a $20 bill. In exchange for that $20 bill, somebody gives you $21 bills. Now, the value is still the same. It's still $20. It is the same way when a stock splits. If you had one share of Amazon, then after the split, you will own 20 shares. The price of the stock will be divided by 20. So the value does not change. Now, there is a psychological thing that happens when someone sees a stock go from $3,000 a share to $150. The mind automatically says, whoa, this stock is way cheaper than it used to be. Now, if you are with a brokerage firm that does not allow fractional shares, of course, it will be cheaper. But if you are with a brokerage firm that does, a brokerage account that does allow fractional shares, then the stock price really doesn't matter as much because you're able to buy fractional shares. So you can buy into Amazon at $5 or $10 or whatever amount you can invest. So the stock split, it won't really matter as much from a standpoint of how cheap the stock is. Over the last 20 years, Amazon has compounded at 32% a year. That's a compound annual growth rate of 32% a year. So a $10,000 investment in Amazon in 2002 will be worth about $2.8 million today. Likewise, by comparison, a $10,000 investment in an S&P index fund will be worth about $54,000, compounding at right around 9% per year. So even though it's compounded at 32% a year, Amazon was actually down 16% in 2004, 16% in 2006, 45% in 2008, and 22% in 2014. So you can have anytime a company that you own can have a year where it's down 10, 20, 30, 40%. But it's all about what the company does over time. And when you own a great businesses can compound at a high rate for a long period of time. Now, I've been buying Amazon for the past 6 years. So here are some of the times that I bought Amazon. Prior to Charles Schwab allowing us to buy fractional shares, you had to buy a whole share. So you see here, October 24th, 2016, I bought 3 shares of Amazon. At that particular point in time, the price was $834.19 per share. And Charles Schwab used to charge a commission of $8.95 per trade. So the total amount invested was $2,511.52. On December 28th, 2016, the price had actually reduced. So I bought 4 shares at $772 a share. Commission charge was $8.95 for a total amount $3,099.70. On April 5th, the following year, 2017, now these are just some of the times I bought Amazon. It's not every time. So I bought 6 shares. At that time, the price had gone up to $910.54. So the total amount, the commission then was $4.95. So the commission had reduced from $8.95 down to $4.95. Now it's free. There's no charge for buying a stock at Charles Schwab, which I love. So the total amount invested was $5,468.19. The next one was September 26, 2019. I bought 5 shares at $1,000. The price had gone up to $1,748 a share. And the commission, again, $4.95 for a total amount of $8,744.96. Now, when I bought these shares on that particular date, I did it with the funds from the sale of Pfizer. So on September 26, 2019, I sold 242.2517 shares of Pfizer. At that time, Pfizer was $36.12 a share, and that came up to $8,745. Now, I have these notebooks. So since 2019, every single investment decision that I've made, every single buy, every single sell, I have it written in a notebook. I do it for two reasons. Number one is because I view things in 5-year increments. So I'm able to go back and look at it to determine whether or not I made a rational decision. I don't make any decisions investment-wise without putting it on paper. I can go back and look and see if my decision was valid. And number two, the notebooks that I have, these can be passed on to my daughters. So when they can look through these and they can see while I made certain decisions, the notes that I took behind it, and how the accounts grew over time. So let me read through this. While I believe that the buy and hold method, now this is my philosophy on this particular date. While I believe that the buy and hold method of buying quality companies and holding for many years is the best way to build wealth, there may be times, albeit very rare, where the sale of a common stock may be justified. Philip Fisher, in his wonderful book, Common Stocks and Uncommon Profits, listed only 3 reasons to sell a stock. Of course, that's absent of the need for cash for personal use. Now, I have a video for that. I will list the video in the description below, so please click on it and watch that particular video. The reason for the sale falls in the number 3 category. Pfizer was purchased in 2016, and since that time, my knowledge and understanding of different companies has grown tremendously. Pfizer has underperformed the S&P over the last 5, 10, 15, and 20-year time horizons. Since purchasing the shares 3 years ago, nearly all growth has been from dividends, with less than $250 in capital appreciation. However, during the same time frame, Amazon has grown from a $17,000 purchase to over $35,000 with over $17,000 in capital appreciation. While I'm usually not inclined, so that means it pretty much doubled in 3 years. So it's going along with the same, close to the same growth rate that it's done for the last 20. While I'm usually not inclined to sell a dividend paying stock for one that does not pay a dividend, I believe that Amazon shares will offer far superior results over the next 15 to 20 years. So you can see I purchased 5 shares with their at $1,748, and the cost was $8,744.96 from the sale of Pfizer. At the time of that purchase, I had 25 shares of Amazon. So those 25 shares total in value was $43,700.06. Now, as of March 18th, Amazon's stock price was $3,225. Now, those same 25 shares today will be worth a little north of $80,000. So they've pretty much doubled again in less than 3 years. So over the last 6 years, the shares I've owned have pretty much doubled twice, in pretty much in the same fashion that they've grown for the last 20 years. Now, this is what I wrote on June 8th of last year. Amazon on June 8th, Amazon was $3,261 a share. I wrote that Amazon was my largest position. Amazon traded sideways from about July 2018 to April 2020 before it broke out. I bought 5 shares on September 26, 2019, which I just talked about. It has basically been going sideways again since about July of last year, which was July of 2020, despite tremendous revenue, earnings, cash flow growth, etc. I didn't really buy any more Amazon until recently, and I think it's a great value under $3,500 to $3,700. Now, when the stock price splits on a split adjusted basis, that is $175 to $185 per share. Don't think because it's over $3,000 it's expensive, because it's priced relative to its value and potential growth. Hopefully, it can stay in that range for the next few months to a year while I continue to buy more before it inevitably shoots up past 4,000. So the stock price to me in isolation is irrelevant. I am not buying Amazon because of what I think the stock is going to do. I'll buy Amazon based on what I believe the business is. So at that particular point in time, the price went from $3,200 and it went up the next month. It had gone up to $3,700. And then they had their earnings release, and by some analyst report, they had a disappointing earnings. And then the price dropped 7% in a day. Now, I didn't freak out. I didn't say, oh my God, Amazon is down 9% in the past 5 days. I'm going to lose my money. I need to sell it all. No, I said Amazon is back where the price range where it's cheaper. So I invested another $500 into Amazon because I want to own more shares of the business. Now, speaking of the business, we just look at some of the aspects of Amazon from 2017 to 2021. In 2017, Amazon had a revenue of $178 billion. Last year, it was $470 billion. The net income in 2017 was $3 billion. In 2021, it was $33 billion. The total assets in 2017 was $131 billion. In 2021, it's $420 billion. The shareholders' equity. When you buy a stock, you are a shareholder, which makes you part owner of the company. So as a shareholder, I am part owner of this company that in 2017 was worth $28 billion. In 2021 is $138 billion. The retained earnings, if the company paid a dividend, which Amazon does not pay a dividend, the retained earnings will be all money that is left over that can be plowed back into the business for future growth or mergers and acquisitions or however the company chooses to use the money. In 2017, they had retained earnings of $9 billion. In 2021, it was $86 billion. See, when I talk about buying companies and buying businesses to own, this is an example of a business. I have no desire to say, I don't know what the stock is going to do. It can go down 20% or 30%. It doesn't matter because I plan on owning this business for a long time. As long as it's fundamentally sound, I will continue to own it. Now, if you look at the earnings per share, the growth over the last 5 years, it has grown close at 68% a year over the last 5 years. The revenue or the sales growth, 28% a year. The cash flow has grown at 44% a year. So the idea of selling an outstanding business, one that continues to grow at an extremely high rate, even with the size of the company, it continues to grow at an extremely high rate. To own a business like this that you can own for many, many years, and you just allow the retained earnings to just continue to grow and continue to build up your wealth. Now let's look at some of the analyst ratings of the analysts. There are 37 analysts that cover the stock. All 37 have a buy rating on the company. The average annual target price for the next 12 months is $4,215, which represents basically a 28% upside from here. So a lot of analysts predicted it is going to increase by a substantial amount going forward. Maybe it happened before the stock split. Maybe it will happen after the stock split. I don't buy the stock, again, like I said, because of what I think the stock is going to do. I believe in owning great businesses. And if you own a group of great businesses, Amazon is one, Apple is another. If you own great businesses and you just allow these businesses to compound, you don't have to trade in and out of stocks. You don't have to day trade. You don't have to do futures, short selling. You don't have to do any of that. You can do it if you want to. It's your money. But I see no purpose or no need to do any of that, especially when you own a group of great businesses that compound your money at a high rate. All you have to do is be patient and just allow your money to compound, allow your money to grow, and that is how you can build wealth. No need for day trading, no need to trade options. I think that about 90 to 95, maybe up 99% of the people who are trying to day trade or trade options probably shouldn't be doing it. Over time, owning great businesses and just allowing these businesses to compound is how you can build wealth. One share at a time, one company at a time. And you don't have to own every company. You don't have to know everything about every single company in the world. Just a group of really good businesses. Own these businesses and just allow the people who run these businesses to build your wealth. There's nothing I have to do. I don't have to call anybody at Amazon headquarters and ask them anything about what's going on with shipments or quality control or anything. Own great businesses. Own great businesses. That is my message for today. Buy, hold, and prosper. All right. I will talk to you soon. Have a great day. Oh, and yes, I will be buying Amazon. I will continue to buy Amazon. I bought Amazon every single month since January of last year. I've continued to buy more Amazon. I will continue to buy Amazon. But it's not the only company that I buy. Because of fractional shares, let's say you have $500 to invest. You can take $100 and you can put it into 5 different companies if you want, or you can take $50 and put it into 10 different companies if you want. That way you spread your money across different companies at the same time, as opposed to trying to figure out what one company is going to be the company that's going to make you rich. Just own a group of great businesses and allow them to build your wealth. Buy, hold, and prosper. All right. I will talk to you soon. Have a great day.